Sure. Yeah. Once again, this has been sort of an ongoing discussion now for, well over 2 years. I think it was sort of in 2018 when it really started to play out. So elements of the sort of the spat between the US and China has, well and truly already been factored into a lot of the outlooks of the businesses that we invest in. In terms of it being quieter in recent months, that's absolutely the case. I think maybe President Biden's preference not to sort of, put out all of his doctrine in tweets helps with regards to that fact. I think these things will get resolved over time. There's obviously a lot of negotiating that's still required between the politicians. We've been very mindful of how we get Chinese exposure over the years, not just in the last couple of years, but for the longer term as well. So we do have exposure to the Chinese economy, but we've been somewhat selective through how we get that exposure.
Now, Jeremy, I know that you can't comment on IPOs specifically, but clearly a lot of focus this morning on the Deliveroo IPO here in London, and I just want to address it from the perspective of investors' appetite for companies that are loss-making, and how long investors are prepared to wait for companies to turn profitable, because this has been a huge theme for the broader tech sector over the last several years. Some investors think it's nuts to be putting money to work in companies that are loss-making without a clear road to profitability. Others say that it's just a waiting game and this is the price you have to pay for growth. So how do you think about the overall appetite of the investment community to wait for profitability at this point in the cycle, given where rates are and where they could potentially be going?
We are, whilst I can't talk about any specific IPOs, we're very selective when it comes to participating in the IPO market. We do a lot of work on companies that are coming public, but we actually very rarely invest in companies that are doing IPOs. We prefer to wait to see how well they execute for a period of time after coming public before making decisions whether to invest in those. One of the things that actually quite often stops us from investing in companies at the IPO stage is their roadmap to profitability. We're somewhat risk adverse when it comes to investing in companies that haven't got profit on the near-term horizon. The vast majority of our investments, and when I say the vast majority, well over 95% of our investments are expected to be profitable within the next 2 years, and the vast majority of them are profitable right now. So we have a preference for companies that are already in the black. The broader market, risk appetite, swings back and forth. Certainly last year it felt that there was a period where the risk appetite had got much higher, and investors were willing to sort of participate in these deals for companies that weren't forecast to deliver a profit for several years. And maybe, on the back of sort of today's events with regards to the Deliveroo IPO, maybe that gets reined in a bit over the coming months. We'll see. I think we're at a very volatile period of investor sentiment right now, with regards to having sort of witnessed some pretty healthy returns in the equity market in 2020, and with still a lot of uncertainty with regards to reopening and the end of the pandemic in 2021.
Right. A quick question just to round up the discussion as a follow-up to what Juliana was raising. Do you think that investors are becoming a lot more discerning about the types of companies that they invest in, particularly if the business model relies on so-called the gig economy, on contractors? We've seen in the case of Uber recently, there's been a reclassification of their workers to official employees. We're seeing unionization efforts go on in the U.S. With Amazon workers. Is this going to be a big theme going forwards?
I think it's an area, clearly, how workers are treated and looked after is a really important area, and something that all businesses should be considering. So I think there is going to be a lot more attention on this in the future. So those companies that maybe have benefited from sort of some of the rules around employing flexible employees might find themselves under a bit more pressure going forward. And there's the obvious candidates. You've mentioned some of them who usually get caught up in these in these discussions. But some of them also offer a lot of benefits to their employees as well. I know Amazon has a lot of programs in place which helps their employees sort of progress themselves and gain further qualifications. So, there is an element of temporary staffing required in these businesses, but it's also about more how they support and nurture that staff as well, which is a really important part of the discussion.